Good evening and welcome to the One Finance Masterclass. My name is Sonam Khatri. I'm an AVP Marketing at One Finance. These masterclass at One Finance are built and designed in such a way that you can take informed decisions towards your personal finances. Qualified experts from different fields join us in making this happen, where they help you, assist you, and guide you towards different aspects of your personal finances. Today, again, an interesting topic with in front of you all, women and finance. It's such an important topic, right? Women have always been the housemakers, the homemakers, to even call as the home ministers. But when it comes to finance, it's always said that they are lacking at quite some aspects. It's maybe because of too much information out there or no confidence for the same. Let's understand why this is changing today. Yes, it's changing today. We are seeing the world taking over control over their personal finances. Women are taking control of their personal finances now. And to guide them and assist them today, again, we have a qualified expert who's going to take you through today's masterclass. So let's get started. Let's bring our guest for today's evening, Lisa Pallavi Barbora. Please welcome. Thank you so much for joining us. So, just to introduce you to our viewers right now, she's a financial coach, she's a personal finance content creator, and founder at moneypuzzle.in. She has around 2 decades of experience in wealth and asset management, and obviously about writing a lot about your personal finances. So, thank you, ma'am, for joining us today
Thank you.
and taking us to today's slide. So, first of all, tomorrow is going to be Women's Day. So, very happy Women's Day to you and all of your viewers who are
Women's Day.
watching today. This session is definitely interesting for me as well. We are taking control of finances now. We are taking complete control when it comes to decisions over personal finances, but it has been lacking for quite some time. What do you think is the reason, and now what has changed, and what has changed that now people are taking control of their personal finances?
So, I'm very excited to do this because personal finance is a very, very important subject, and portals like yours are talking about financial awareness, which is great. And there are many layers to this, and there is knowledge. So you address the lack of knowledge. There is experience. You once you get the knowledge, you can start to address
Yes.
experience, and then there is a whole belief system that we all come with. And I think that's the hardest to fix. But we'll talk about some of this today. So
Sure.
let's see how we go.
Absolutely, the floor is yours. Just to remind all our viewers, this session is live on LinkedIn, Twitter, and on the One Finance website. You can put all your questions in the comment section. We'll be taking the last 10 to 15 minutes to take all the questions, and Lisa
Yeah.
ma'am will be definitely answering maximum of them. And if not, she will be specially going on our page and putting those answers if needed. But we'll try to take the maximum of them. Floor is yours, ma'am. All the best. Thank you.
Thanks. So, financial planning is obviously essential for women at every stage of our life, right? But when we think about money, what happens is that there is so much to think about, right? So many numbers that come up in front of us, and the mind really boggles, and you don't know which number to take up, which number not to take up. So many times I have heard, in response to this kind of mind boggling confusion, I've heard women say, I don't understand numbers, and just pass on that baton to whoever else is there. And when that happens, when enough number of people repeatedly say that, it becomes a self-fulfilling prophecy. And as I was just telling Sonam, that there are few layers to this, right? There is knowledge, which we can address. It's easy to address, man or woman. There is, what do you say? There is experience, which also we can address. The hardest thing to address is the belief system. And today, hopefully, what we are going to try and do is address the knowledge and also look at the softer side of money, which is the emotions and the belief system that guide our actions. Okay, so as you can see, there's a list of topics, and this is what we are going to cover today. By the end of today, hopefully, you would have understood the basics of personal finance, how you should approach it, and also you will understand the role your emotions play in building that money relationship. Okay, before we begin, a quick poll. The question is there in front of you. The biggest obstacle in managing your finances, is it lack of knowledge, impulsive spending, navigating investment choices, or balancing debt and savings? So, if you can just answer that very quickly and then we can move on. I hope everybody's getting into answering those, picking the right option. Okay, so we've got some responses. Yeah. And lack of knowledge and impulsive spending. So these seem to be the biggest obstacles in managing personal finances. And you're at the right place because we are going to address both these issues really in today's talk. There you go. So, as I was saying, that money boggles the mind, but instead of making it a self fulfilling prophecy that I don't know numbers, which a lot of women really do that, I don't know this. Let's instead try and address it and try and change it because it doesn't have to be so. So, what are the numbers that you really need to know? It's not that complicated. What you can see on the screen, income, which is the first thing, which everybody understands, is the money that's coming in, okay, coming in to your household. So it could be a single income household, double income household, whatever, but money that comes in, your income is an important number. Expenses, what you spend on, that's also an important number. What's left over is your savings. Then comes wealth, which is basically your assets that you have. And assets help you and help your money to make more money, right? So that's very important as well. And then there is your debt or the money you owe, loans that you've taken from the bank or from somewhere else for whatever purpose. So these five things are very simple things to understand, but the most important number is this: inflation. Okay, inflation impacts everything in our life. What is it? It's basically price rise, right? So over longer periods of time, what happens is that prices of everything goes up, right? So one of the basic things like tur dal or arhar dal, what we know, in 2010-12 it used to cost 65-70 rupees a kg. Today it costs maybe 200 rupees or so a kg. So that price rise is inflation. Petrol prices have doubled in this period of time, what I'm talking about. So if you had 100 rupees back in 2010-12, you could have bought 1.5 kgs of tur dal. Today you can't get even half a kg, right? So the value of your 100 rupees is depreciating, and over a long period of time it really shows up. So inflation is a very very big issue which is external to us but impacts us heavily, and that is why we need to understand how to manage our personal finances. The typical cycle of money that any household has is you earn, you spend, and you save what's left over. What you need to do really to make it work more efficiently is to earn, save first, which is pay yourself first, and then spend. You see, if you always rely on leftovers to fill your stomach or your hunger, sometimes it'll be enough. But there will be times where you're left hungry. And then you have nothing to go for. So why not instead save first so that you have taken care of your hunger today and your potential hunger in the future as well, and then spend what is left. If you fix this, a lot of those issues around savings will get addressed. So let's get into how you can save, and of course, what everybody wants to know, investing. Okay, before that, another quick poll: which investment type interests you the most? See, before we get into investments and investing strategies, etc., let's focus on the basics, which is how to save. Because unless you are saving, investing does become very hard. And remember, simply saving is not investing, because just saving your money and leaving it in the bank is going to open it up to be eaten by inflation. The value of your money gets eaten by inflation if it's left in the bank. Saving is not enough. You have to try and invest to fight inflation and improve the value of your money and grow it. So, what we spoke about earlier, you have to save before you spend. So, that is the primary thing to do. Now, you're thinking that, okay, I have to save before I spend, but how much do I save? So, there is a rule of thumb, which is the 50-30-20 rule. And this is just a guide, okay? This is not, this is not something that you must follow, but it's just a guide. What does this rule say? That 50% of the income you get you should use towards your needs. Now, if you have an EMI, if you have a rent to pay, then yes, 50% is going to be required. If you don't have these things by chance, then you'll need probably even lesser. So 50% on your needs, 30% on your wants. Go for those movies, that travel, entertainment, whatever you want to do with the 30%, and save 20%. Okay, so that's the 50-30-20 rule. That is how you can keep a target amount. Okay, so now we are beginning with, say, a 20% target amount, but you're thinking that, okay, I have 80% to spend, but is it going to cover my expenses or not? That is why you must track your expenses, and you can do it on an Excel sheet, you can write it down, or do it however you like. But unless you track your expenses, you won't know where you're overspending. And believe me, a lot of people, when they track expenses, actually realize they're underspending on the things that they want to spend on. So it's a very useful thing to do. Do it for a few months till you intuitively know where most of your spending is happening. Again, Excel sheet, there are apps also which are available for this. So pick the way you want to do it, but track your expenses. If after all this you don't have the savings amount, the minimum like a 20% savings, then start cutting back on wants. So reduce the number of coffees you're having at Starbucks, reduce the number of movies, whatever it takes. Cut back on wants if you're not reaching the minimum kind of saving that you want to do with your income. Okay, again, one last thing I want to talk about before we move on to investing, and we will get there, is financial necessities. Okay, so one of it is insurance. What happens is that every now and then we encounter some kind of a financial emergency in our life. Thankfully, there is a product like insurance, which is like an umbrella or maybe even like a safety net that kind of covers you against any financial upheaval from an emergency in your life. Now, the biggest kind of emergency is an untimely death. And when that happens for the primary earning member of the family, then the people who are dependent on that person for their financial, kind of health, for their financial needs, need some backup. And life insurance policy is the first necessity for any person who is earning and has dependents. But not just any life insurance. You can see I've put there insurance is not investing. So a lot of the traditional life insurance policies, like your whole life, money back, endowment, they do have this investment component to it. However, that investment gives you nothing more than maybe 4 to 6% return over like 20-30 years. And at the same time, you might think, but so what, it's giving me a life cover. But the life cover you get is relatively very small compared to if you take a pure term life insurance policy to safeguard your dependents from financial upheaval if you are not there. And if you're not the earning member, make sure that the primary earning member in your family has a term life insurance policy. A term life insurance policy costs like almost one tenth of what a traditional life insurance policy will cost. And it has a life cover which could be as much as three times more. So if your traditional policy is giving you 1 crore, for one tenth the cost, you can get a 3 crore life cover from a term life policy. So that is the first thing you need to put in your household to protect them from any kind of untimely death of the main earning member. Then there is motor insurance, which in India is anyway mandatory, but make sure you get the right kind. Don't skim on the premium and take the basic one. Take one where if you have a big accident with your car, you are not scrounging from your savings to pay up for repairs. The insurance kicks in, right? That's the role of insurance. If something happens, which is an emergency, you don't have to dip into your savings, your long term savings, especially. Insurance kicks in and pays for it. Health insurance is the second very important insurance that you need to take care of, because health emergencies do happen and they can cost a lot. Health insurance covers hospitalization costs, some pre and post hospitalization costs. There are insurance covers which even have this preventive health checks. They even cover those kind of expenses, so make sure you get that. You get your home insurance. So if there is a robbery in your house or some kind of structural damage, insurance can cover it. And of course, travel insurance. So if something happens to you or your family while you're traveling overseas, again, you don't have to scrounge for your savings which are back home. The insurance kicks in and pays off. For anything else, what else you might think, but for anything else, like a job loss, like a relative who needs a lot of money for their life, you should think of having an emergency fund, which is just money kept aside in case of any other kind of financial emergency. And make sure you have a substantial bit in that. And typically, what I suggest is about 9 months to 12 months worth of your non negotiable monthly expenses. So, things you cannot do without in a month, add up what they cost and just put them aside, worth, about 9 to 12 months. So that if there is a sudden job loss, and we've seen it happens in COVID, right? Or if, your brother has an accident and doesn't have health insurance and needs a lot of money, at least you can help out because you have that emergency fund money and you're not again dipping into your long term savings or your investments. So these are a must before you start investing. So now, why and how to start investing? So we already spoke about inflation. Remember how I showed you that in 10 years, 15 years, prices of things can double, triple even, and it can be as simple as the groceries you buy to the fuel you are buying. So everything gets affected. Rents you are paying, the cost of the house you want to buy, everything escalates. So unless you're investing your money in such a way that the rate of return you are getting on your money is higher than the rate of inflation, your value of your money is actually falling. So if you want to create wealth for the future, then you have to invest to beat inflation. And of course, there will come a time in future where your income source will not remain, right? Either it's a salary job and you retire, or it's a venture and you want to start focusing on other things, and the income coming from that venture is reducing because you are not putting in that much time and effort. And usually it happens at a later stage in life, beyond 60, 65 years of age. So you want to invest so that you cater to that part of your life. But how do you invest? So here it is. You need to take some help when you want to invest. And it could be a financial advisor in person. It could be an online financial advisor, which, who guide you to what kind of goals you should have and how you can allocate different assets and investments to those goals. It could be an online platform which is do it yourself. So you can pick the investment options yourself if you understand enough. And it could be your bank, a relationship manager, or even the bank's online platform. You can go and select your investments and go ahead and make them. But before you start investing, spend some time in understanding what you're investing for. Because unless you understand what you're investing for, you will just blindly go and buy an investment where you think you will make the most return. And that's not going to always help your cause. So, what I have done here is I've tried to put in two baskets: short term goals and long term goals. Short term goals are things which are a high priority right now in your life, okay? So maybe you want to buy a house a year down the line, and there is a particular amount you want to put as down payment. So you have to save up for that, right? So that is a short term goal. Anything between a few months to a year or 2 years is a short term goal, because it also has high visibility. Your travel next year, for example, or if you want to buy a vehicle, change your vehicle, then that's also a short term goal. So these are short term goals. They are visible. They are important right now. It could be some home repairs that you want to do in the next 6 months. They require an investment which is relatively safe, because it's not so far away in the future. You cannot kind of negotiate the amount you need. You know that, okay, for home repairs you will need this much, and it's only 6 months away, so the amount doesn't really change. Okay, so you need an investment which is safe and stable, and usually these demands are inflexible. So because it's so close and it's so visible, so you cannot really change what you require in terms of how much. Long term goals, on the other hand, um, are much further away, at least 8, 10, 15, 20 years away, and they have a much longer lasting kind of monetary impact and a large monetary impact. So retirement is a very common long term goal, and it could be 20 years away or 15 years away or 30 years away, but a few years is what you have for your long term goals. Usually retirement, children's education, if you want to start your own venture after 10 years, you can start planning today for these. These are, the amounts are a little bit flexible, because it's 10 years away, so your estimates can change as time goes by. They have to be, like I said, inflation beating, because over a long period of time inflation does tend to impact the value of your money. Okay, so once you have done this short term and long term, then you start thinking about where you need to invest. So for short-term goals, you can pick, as I said, safe investment options like bank fixed deposits. Or if you are a mutual fund investor, you can look at liquid funds, overnight funds, money market funds. These are funds that really work for short-term goals, because they are very, very low risk. So the value of your investment does not fluctuate, and you can leave your investment in for short periods of time, like 6 months or 8 months. For long-term goals, there are equity shares, equity mutual funds, the National Pension Scheme, which is also something that's instituted for retirement income. The PPF is a popular one. Most people already know this. It's also the most tax efficient long term investment, because you get a tax deduction for the amount you're investing up to 1.5 lakhs. The interest you receive is tax free, and whatever amount you receive at the end of the 15-year lock in is also tax free. The EPF for salaried employees is anyway going as a part of their cost to company. And unit linked insurance plans, these are all options for long term investments. All of them have a element of equity investing in them, because equity as an asset is a growth asset, and over longer periods of time, historically it has been known to beat inflation and grow your wealth. What I've put on this side is your diversification elements. So, why am I saying that real estate is diversification? Because, sorry, real estate is an asset which, yes, is a growth asset. So, over time, its value does tend to become more and more. However, it is not a very flexible, it's not a very kind of liquid asset. So if you've planned, for example, your child's education, which is 8 years away, by buying a flat, and you're thinking that, okay, you know what, when the time comes, I'm going to sell this flat and I'm going to get the money I need for my child's education. What can happen sometimes, and it is known to happen with people, is that if it's an under construction flat, it may not even be close to completion, because we know construction delays happen. If it is fully constructed flat, you may have trouble selling it, because if nobody is going to buy it, a physical asset like that is not easy to sell. There's a lot of paperwork. Then there are other costs involved, registration, stamp duty, etc. So it's not a very easy asset, not a liquid, flexible asset to handle, as say your equity shares, mutual funds, etc. are to handle. So that's why, yes, you can have the real estate, but don't make it the most important long term investment. Gold as well, I have put here. Gold has been doing really well for the last 2 years or so, and everybody is, looking at gold. However, what happens with gold is that, unlike equity or real estate or even fixed deposits and bonds, gold has no other income, right? So equity gives you dividend, real estate can give you rental income, deposits give you interest. Gold gives you nothing else. You're only relying on a price rise. And there are times where gold prices have not risen in the same manner as what you're seeing in the last 2 3 years. So you can't rely on that for a 10 15 year kind of period. So these are assets I've put as a diversification. Okay, so here you can see, just to show you what I was talking about earlier, and I've not put real estate in here because real estate is very divided in a sense that you have to go to micro markets, and the price changes in micro markets can be very different. However, from the historical data we have, real estate as an asset tends to grow around between 7 to 8% annually in long periods of time. But again, it could be different for micro markets. But what I've done is I've tried to show that over a period of 20 years, and this is actual data, these are not assumed figures, how investments have performed. So if you had invested in the Nifty 50, 1 lakh rupees, then in 20 years, it would have grown to about, I think it's 19.8 lakhs is the exact amount today. In gold, it would have grown to about 11.5 lakhs. And in SBI 1 year fixed deposit, it would be around, I think, 4.2 lakhs or so. So, as you can see, there is a whole big period here in gold where prices haven't moved. So, if you were invested in gold thinking that I will make a return, you wouldn't have. Now, if you can see the SBI fixed deposit line, you'll see that it's a very flat line, right? So that's what we call capital safety. And that's why for short term investments, these work. But over the long term, look at the gap between a growth asset and the fixed deposit. That's your opportunity cost. If you keep it in a fixed deposit, you will not be able to grow your wealth as much. But yes, for capital safety, it works. Now, equity does go like this, right? It's volatile. So, in the short term, if you want to plan your travel next year and you invest in equity, this could happen. And if this happens, then your travel plans go out of the window. So, equity is not meant for 1 year, 18 months, 2 years. It is meant for long term. Okay, and see the difference in these assets, and then you can decide. But the real magic in investing happens when you invest regularly and you stay invested. Growth assets give you the best kind of outcomes. And this is not to do with the asset itself, it has to do with your behavior. If you invest regularly and you stay invested, this is what can happen. A simple 10,000 rupee systematic investment in equity done for 20 years every month. So every month you're putting in 10,000 rupees and you stay invested for 20 years, you can make almost a crore, 98 lakhs, just with 10,000 rupees. For gold fund, I didn't have data for 20 years, so I've taken the 16-year mark. And here also, if you show the discipline to invest regularly and stay invested, just with 10,000 rupees, you can achieve every month, of course, you can achieve 39 lakhs. Or you would have, this is again actual data, you would have achieved 39 lakhs in 16 years. So the numbers are there for you to see, and assets behave as they should. Equity being a growth assets performs the best in the long run, then gold, and then your short term debt fund. But what really performs is that you start early and invest monthly. If you start early, just let me give you this example, that if you start investing in equity early, 10,000 rupees a month can give you almost a crore in 20 years. Now, let's assume that you are making around 12% return in equity. Then, just by investing this 10,000 for another 5 years, you can double it to 1.9 crores. So, it took you 20 years to reach almost 1 crore and 5 years only to double it. And in 30 years, that corpus, if you keep investing 10,000 rupees a month for 30 years, it can become 3.5 crores. So 20 years it took you to build that 1 crore. In the next 10 years, you are tripling your money, right? But you have to have those 30 years, right? You have to have that runway, that 30 years are ahead of you to invest. That is why starting early is important. You can start late and you can begin late, but you'll have to put in a larger amount to achieve that 3.5 crores. In with 10,000 rupees a month, you can achieve it in 30 years. But if you have only 20 years, then you need to put at least 30 to 35,000 a month to achieve the same amount. So if you start late, you have to invest larger sums regardless of when you are starting. Of course, starting early is great. Regardless of when you're starting, you need to start now, because that runway of time is not going to remain. The later you start, the more you will have to focus on putting higher sums on a regular basis. Okay, so this is just a quick recap. So your long-term investments for wealth creation need time. As we saw, 20, 30 years can double, need compounding returns. So you need to have a growth asset where money makes more money. You need patience. You saw that equity graph moving like this. So don't get scared every time it goes down. Be patient and stay invested. You need the discipline to be regular. To enable all this to happen, first fix your financial necessities, get the right insurance cover so that in the event of a financial emergency, you're not dipping into your long term savings and pulling out from your retirement kitty to pay for hospitalization, for example. You need to have some form of regular investing. It could be systematic investment plan in a mutual fund, in shares. It could be a recurring deposit in the bank, which is also a regular systematic way. It helps in automating your investment also, which means that you don't have to wake up every month and think, Aaj kya karu? It is automated for as long as you want to do it. So behavior gets fixed when you are regular and you're systematic in your investment. And of course, knowledge. Fixing the knowledge is in your hands, and there's a lot of information these days. Make sure you're getting the right quality information. Go to an advisor, go to a coach if there is any doubt in your mind. Okay, so before we get to the softer aspects of money, I just want to quickly run through what loans and what debt does to your personal finances. We forget about interest cost. Often, the longer the duration of your loan, the more the impact of interest cost will be. Okay, so a 1 crore loan at 8% for 20 years, a 20-year tenure usually is for a home loan. Your interest cost will be as high as the value of your loan. So interest cost is as high as the value of your loan. Remember, so you have to think about repayment and prepayment. 1 crore loan amount, 1 crore interest. Longer the tenure of your loan, longer your interest cost. Different kinds of loans have different interest costs. According to the Reserve Bank of India, also Indians are now slowly piling up debt, and the problem begins where you start piling up debt. And in the next slide, you will see that there are all kinds of loans and they come at much higher cost, but these are lower tenure loans. So the absolute impact of the cost is not as high as your home loan interest cost, but nevertheless, look at the percentage of kind of interest that you will be paying. If in 1 month you don't repay your credit card, it's a 3% absolute cost for you. So that's a big hit. But all of this aside, when you pile up debt, the real cost is not just the money you're paying as interest. The real cost is that you are tied down to the job you're doing, you have no freedom to move forward. Your peace of mind, your relationship, your self-confidence, everything starts to get impacted when debt is piling up. So sure, take the important loans that you have to, but just be mindful that you're not tying your life up in loans. Okay, now we move very quickly to the softer side of money. And as I said, it's our emotions which guide a lot of our money action. It could be that the action we take is because of our emotion, or it could be that something that's happening with our money is actually causing that emotion to occur. Okay, so very quickly, the third poll: do you believe your emotions affect your financial decisions? Yes, no, maybe. So we'll just take very little time because we have only about 15 minutes left, and there are a couple of things we want to get through before we start the question and answers. Right. So yes, and maybe that's the split of the answers that we have. So everybody thinks that yes, emotions do have some role to play, I guess. But where are these emotions coming from? Well, let's just see first what role emotions have to play. And as I said, it could be that your actions are dictated by those emotions, or that you take the action because of a certain emotion. Just see, okay? And this holds for all of us. If we are happy, what do? We want to celebrate, right? So we go out and we have a party, we spend money. If you're angry, you want to, you've had a fight with your colleague, with your spouse, with somebody in your house, you want to compensate. So come on, let's go for a movie, come on, let's go for dinner. Okay, here's a gift for you, hope you feel better, and I'm sorry. You spend money. If you're sad, well, let's plan a trip, let's go somewhere, and let's feel better. Again, you're spending money. If you're bored, scroll and let's buy something, right? And again, we are spending mindlessly. So emotions do guide your actions with money. Also, a lot of times the actions that you take with money are based on emotions that arise because of beliefs. Remember, we spoke about that belief: I don't know numbers, I don't do numbers. It's a belief. If these, and beliefs basically come from our childhood, and they are subconsciously there, we don't really think about them, but they are there. Now, some beliefs are empowering and they are good for us. But if a belief is limiting, it is tying us down, it is preventing us from achieving the potential we can with our financial decisions. And let me take this basic belief, that money and investing are a man's domain. I don't do the numbers, right? It's limiting you from actually doing the numbers, because as you can see, the steps are simple: knowledge, awareness, experience, and action. If you want to actually change the outcome, then you have to change your basic belief and make it an empowering belief. So what is the empowering belief to, money is a man's domain, which is a limiting belief for women specifically, that money doesn't have a gender. Money doesn't care whether you're a man or a woman that's managing it, right? And women can manage it as well as men. I can manage it as well as anybody else. That is the empowering belief for something that's limiting you when you think that money is a man's domain. Another money belief, I'll just take one more, and you can see there are examples of what limiting beliefs are. And you know that when you have a limiting belief, it's preventing you from taking the next step. You need to convert it into an empowering belief. So I'll take just one more very quickly, which is talking about money is rude, it's not graceful, it's unsexy. That is a limiting belief that societies world over have. People don't talk to their children, people don't talk to their spouses about how much they make, how much they save, and it's just like a taboo. However, talking about money actually builds awareness. It gives you knowledge, it makes you more capable of taking money decisions which are relevant to your life. That is the empowering belief. What can you do with all this? Well, purposeful action is the aim, right? Once you have all the practical knowledge and you understand the belief system that's running your money behavior, you can put it all down to the purposeful action you need. And for that, we have something called the wheel of life, and it helps to actually go through this. Our life has many components, as you can see on the wheel. We close relationships, we have our money, we have our personal growth, the physical environment we live in, our health, etc. Now, if you put this out like this, just try and estimate which segment of your life is doing well and which segment is not doing well. If you find, for example, that your health and fitness is not doing well, then you have to see, okay, what's happening here. Then you say, okay, you know what, I'm living in a city, the environment I live in is very polluted, so my health suffers. So then, should you shift that environment to a smaller town where your health will be better? Okay, for that, then you have to have some savings, because you'll have to leave your city job, which pays more, and go to a small town and stay there. So you'll have to think through your household expenses and things like that. So that becomes your purposeful action. Okay, 5 years later, I want to move out of the city to a small town so that my health becomes better, which means that I have to start saving more, which means that maybe I have to, speak to a financial advisor. Now, maybe your health is not improving because you're taking that gym membership year after year, not visiting the gym, because it's not your way of fitness. Maybe yoga is, maybe cycling is. So cancel that gym membership. You're just spending needlessly. Unless you figure this out in relationship to the practical aspects of money and to your beliefs, you will not be able to figure out what the purposeful action you need to take to fix your personal finances. Personal finances are personal, it is about you. It is about your understanding of the practical things in money, like savings, investing, loan, insurance. And it is about the behavior you have, which comes from the belief system. And like we saw, emotions are always at play. And unless you fix your belief system from a limiting belief to a more empowering belief, moving ahead in terms of your personal finance is going to be very difficult. And as women, we hold a lot of those limiting beliefs. So work on that first, figure this out, and take that one purposeful action towards bettering your personal finances. So that's it from me right now. Um, yeah, this is a very nice quote. Money is there to improve your life. So if there are any questions, do put them up and we can take them up now.
Absolutely. Thank you so much, Lisa. This was quite insightful. Instead, I was able to relate to quite a lot of things
That's
that we
nice.
discussed about. And I'm sure a lot of people would have got a lot of ideas how to go about their personal finances, especially women, the beliefs and the emotions that impact us taking calls on our personal finances, something that has now been made very clear on the face. So let's start taking a seat back and start discussing about these things. Okay, so we have received some questions
Okay, that's
and
nice.
let's start with some of them. So the first question is from Neha. She's asking, how do personal finance strategies differ from women compared to men? Considering I have more career breaks, I have a wage gap, my lifespan is going to be longer than them, then how it's going to be?
Excellent question. And
Yeah.
it's actually quite true as well. There are a lot of layers to our life as women. And I think the basics are not different, right? The basics of investing, like I said, money doesn't care about gender. So the
Sure.
investment will perform the same. What you have to do is those short term and long term goals, right? So if a career break is something that you are thinking about, then that becomes, depending on where it is, it should fit into one of those goal buckets, right? So once you fit it in, you start saving accordingly from today for that goal. So if you are planning a career break in, say, 3 years or 5 years, start saving from now. Figure out, like I said before, track your expenses. What are those monthly expenses that you're making? And in then you will know how much to save and for what period of time. So those are the important things to do, to track your expenses, to put your goal timelines, and then move ahead. The second part of it, what she asked was, women live longer. Yes, I find repeatedly that in marriages, and I don't say this as anything, it's just factual, people don't discuss savings. Okay, one will save in their name, the other will save in their name, and they'll spend jointly, from a joint account. While that's fine, the fact is that one of you will live longer. So discuss your savings.
Yeah.
Okay, have a common pool of savings. You, if you want, keep some of the savings aside as individual, but have a common pool which caters to the household, to the family, to retirement.
Absolutely.
You have to, there is no easy way around this. You have to plan, you have to talk. Remember, we said talking about money creates awareness. So build all these elements into your personal finances, and I think it's going to make a difference.
Okay. Our next question is from Tarika. This seems like a budgeting question again. Can you recommend budgeting techniques that cater to varying income levels, especially for women like me who is a freelancer?
Yeah, so freelancers need to be a bit more careful about their spends.
Absolutely.
Because you don't have the same amount of income coming in every month. So again, I go back to basics. One very important thing to do is track your expenses. What is the minimum non-negotiable expense you need every month? Minimum non-negotiable expense. Non-negotiable means that it is like your rent, your EMI, your utilities, what you pay, your health, groceries. and the basic travel that you have to work, etc. These are things that you have in your non-negotiable expenses. Find that figure, okay? And then remember that emergency fund. So have that emergency fund for 9 to 12 months, so that if ever your income becomes really slow and you're not able to cater for it from your freelance income, you have some backup, right, till you build your income levels again. So do that, track your expenses, and when any money hits, right, even if it comes once in 3 months, it doesn't have to be monthly, once in 3 months also, take that 20% and save it, right? Don't wait for a monthly income to save your money. Whatever income comes, even for those who are salaried, sometimes you get bonus, sometimes you get inheritance, whatever income hits your bank at whatever time, take 20%, put it in a separate bank account if you must, so that you don't spend it, or immediately invest it, automate that investment, we spoke about that also, so that you don't get a chance to spend it.
Absolutely. Okay. We have this question from Nisha. She says,
Yeah.
emergency funds that you're talking right now about should be different than men. I mean, it should be more because of the career breaks that we end up taking a lot.
Yeah, I mean, it can be. So, again, it depends on how you are as a household managing your income and your savings, right? If you're talking, if you're communicative with your spouse, you will know what kind of savings you already have as a household. And then you can decide how much you want to keep aside only for your career break. Okay, so it also depends on what kind of expenses you will have. See, when you take a career break, your expenses will also fall.
Yeah.
Okay, so it will not be the same high level because you won't be traveling as much. But if you're taking career break for childbirth, then expenses will go up. So again, you have to see what kind of savings you already have and how long your career break is going to be. But yes, you can plan for every 5 years taking 6 months off. I know a couple which takes a 1 year sabbatical every few years. So they plan it. So when they're working, they are planning for their next sabbatical. So all it requires is to actually put the numbers down and save in a backward way. So once you know that, okay, 5 years later, I'm going to need this for my break, you start saving accordingly.
Okay. Nikita has a question for insurance. So, what type of insurance are crucial for women? Are they going to be a little different because of the different life stages that we have?
So the one different thing is maternity, and there are health insurance policies that cover maternity. Life insurance is the same, term life policy. Depending on how much you earn, you get your term life cover. Health insurance, yes, maternity does get if you're planning to have a child, but some policies have a waiting period of up to 4 years for maternity, which means that if you take a policy today, then only 4 years later, if you have a maternity expense, they'll pay, not before that. Some policies have a 2 year. Other than that, I think it really depends on your own individual health, because there's no other specific women, because this is health insurance covers hospitalization cost. So you could be hospitalized for any kind of surgery, whether it's specific to women or men. So other than maternity, I think everything else you'll have to figure out given your health.
Okay, this question is from Akansha. She's asking, caregiving responsibilities and career breaks are affecting my retirement savings now. How can I mitigate the same? But how she will able to adjust now? It seems, yeah.
Yeah, so I would think back to that purposeful action slide that you saw, and that wheel of life, okay? And in every little section of your life, mark out what is going well. So I guess for you, what is not going well is, your career and what you're making out of it. So when you start thinking of it from that perspective, you start thinking, what could my purposeful action be? Okay, so obviously you have to, like you said, caregiving, we can't quit our families, right? That's not an option, right? But is there something that you haven't explored which you can do while giving care from your home, but also it is commercially remunerative? So start thinking on those lines. When you fill in this wheel of life, that's when you start thinking that, okay, I'm lacking in this. Now what else can I do to not give up my caregiving and have a commercially viable setup? Should I be saving more? Are there any wants that I've been indulging in which I can cut back on? So these are things which you'll have to start thinking. And believe me, today we are in a world where technology has enabled all kinds of commercial activities without requiring you to be physically away from home. So you just have to give yourself a little bit of a nudge to think in the right direction, and you will find your purposeful action, which is going to help you be the caregiver that you want to be, and yet have a commercial kind of activity that you can do.
Okay. Okay. There's Preeti who's asking that I want to ensure that there's financial literacy and given it and passed on to my children. How should I get started? I have one daughter also.
Excellent. So I'm all for financial literacy for children, and I talk about money with my children all the time. Basic is start them out on a pocket money very early. And I'll tell you, okay, so it's okay to give a personal anecdote, right?
Okay, we'll try.
We'll try. Okay, so this is just about children. I have two boys, and I started them out on pocket money, and I realized one of them really took to it, right? And he would pick up any change lying anywhere and put it in his little piggy bank. And they were 6 years old back then. And the other one didn't. And I got worried. I said, you know what? This one seems to have a sense of money, the other one doesn't. So, as a parent, you have to be on the lookout, but you have to encourage them to handle money at an early age. Talk to them about money. When you're giving them pocket money, don't let it be just a gesture and then buy them whatever you want, whatever they want from your money. Have those divides and say, I've given you pocket money, you've lost 5 cricket balls in 1 month, so go and buy your own cricket ball with your pocket money. Say no to spending on them for frivolous things. Let them understand that if they have saved some in that little piggy bank, they should be spending it. And as time goes, they will understand the value of money. They will walk into a shop and say, no mama, this seems a little bit more expensive than what I think we can afford. It's fine. We all have our boundaries of affordability, and talking to your children about that is fine. Then once they're in their teens, start talking to them about loans, about investments, and believe me, they will learn and they will pick up from what you do. So unless you say no, unless you say we can't afford it, unless you show them that look, I am investing, you don't have to show them values, you don't have to talk to them about how much you're earning, but show them that look, I am investing every month and look how that's helping me. So yeah, so all these things you can do with children.
Absolutely. Okay. This is a question actually I would like to ask. The question will be around, building something for the next generation. It can be building wealth, generational wealth, as we can say it, or even passing it on, right? Like whatever we build as women, it's usually not taken seriously. कि कहाँ रखा है लॉकर में कुछ रखा होगा देख लो हो गया. But when it comes to men, they are making wills, they are making it sign, and they have to be ready with all that. Why are women not taking this seriously? First. Second, should they be focusing on this or not? And at what age maybe they need to do this?
So, first question: why are women not focusing on this belief system? Hello, it's a man's job. It's not a woman's job, and women are as guilty for having this belief system as men are. We have to change it. There's nothing stopping women from having a will. If you have a substantial wealth that you want to leave for any purpose, for your children, for charity, for a foundation, for you want to give it to an orphanage, whatever you want to do, you can. And like I said, a will really helps to kind of articulate that, put it in a organized format. And mm, again and again I say this, money doesn't have a gender. Money doesn't really care whether you're a man or a woman. It's just you who are thinking that I can't do this. So women should do it. Is there an appropriate age? Well, the age is not the appropriate number, it is the wealth. If you have a substantial wealth which you think you will not need for your own expenses through old age, you may have catered to your old age income already, then yes, definitely go ahead and make that will, and give that inheritance to somebody who you think will benefit from it.
Absolutely. Thank you so much, Lisa.
Thank
This
you.
was
Thank
really
you.
insightful session
Thanks a
for
lot.
everyone out there. We will this recording will be available on all the platforms. You can watch our other masterclass also on our website anytime you want to. If you missed some parts of the session also. You can go and watch it again. You have still any questions about it, please go ahead and send us in the comment section. We'll try and get the answers from Lisa ma'am here. Thank you so much everyone for joining, and all the women out there watching this show right now, or all our viewers, very happy Women's Day. We really request all of you all to start taking control of your personal finances, because you have already done that at multiple levels. It's just that you have to take it in your control now. Thank you so much again. Thank you so much,
Thanks a
Lisa,
lot,
again.
and a happy
Have,
Women's Day to
bye-bye.
everybody.